John, you're on mute. Hey, Cody. Who else do I got here? Greg Wells, are you able to come off mute for a minute?
There. Yep, for sure.
Oh, there you go. Hey, Greg. So there's John. So yeah, Greg, just real quick and dirty, like your area. What I like to do, John, if you remember from our last visit, just kind of go around the horn just briefly, just to kind of get a bit of a take on what's going on in the field or not. Lots of snow pushing and all the rest of it. But from your take, Greg, from your people you work with, you've got people from Manitoba and then right over to your area in that Flaxcomb area. Where's the guys' mindsets in terms of percentage marketed, and where are they at in terms of solidification of cropping plan?
Okay, so the marketed grains is ramping up here because, of course, the FCC and Scotia lines are due, but the rail line that generally used around here is probably 3 weeks behind, which is season right now. So I don't know how. I mean, FCC's not till 20th of March or something, but the guys that are on Scotia probably don't get the grain out in time to pay it. And then the flip side of that is lots of guys are still waiting for crop insurance or figuring out their insurances before they fine tune what they're going to do for seeding. And there's still lots of guys haven't really bought much of anything yet over here. Still trying to figure out seeding plans. And then, like I said, guys are hoping to see pricing go increase, and that really hasn't happened. So they'll be just dumping the grain to pay the bills and then get comfortable with what they're doing and buy some chemical again.
Do some exchange. Yeah, I was just sending out finishing off a text I'm sending out to some folks that you guys, some of you may have got it, but since Jan, we've got anywhere between $45 and $100 a ton increase on the bulk fertilizers, the 46th and the DAP, MAP, and the K and the S. 46 was on, in some instances, a little bit of an allocation. Earlier, we had a bit of sulfur on a bit of allocation, and now that is over with. However, the price is up $75 a ton. K is up there as well, regardless of where it's, even though we can see it from our backyard, the price of potash is going up and things like that. Phos is relatively static, but that being said, lots of guys are getting to the short strokes of doing some finalization of crop plans and all of that good stuff. So, but what I'll do, because I don't want to, thanks for that, Greg. Really appreciate that. What I'm going to do is just have a visit with John here now. If you want to come off mute there, John, and want to thank you again for taking, this is our second time we've had a chance to have you speak to our group, and I was grateful for that. And for those that are not abreast as to your bit of your history, do you mind just giving like a quick and dirty minute or two about what your history is and how come you're sitting in the chair you're in today? Other than we're all in this crazy game of agriculture, right?
Yeah, sure. I've been around a long time, I'm afraid to say. But, I guess I started as a trader or merchant at Cargill years ago. And from there I went, I just wanted to try my hand on the trading floor as a local trader. So I left Cargill to do that. Well, that was a long time ago, 88. And from there I went to work for the exchange as director of marketing, and got involved in a big event in 1994. XCAN squeezed the market in a big way. And I was put in charge of the investigation. We redesigned the futures contract. I guess it came out in 95. The contract, as it trades today, I was involved in the design of it and implementation of it. That was 95. I left the commodity exchange to work for a company called Sparks, based out of Memphis. Willard Sparks started it. I opened a Canadian office for them. We did project consulting as well as market analysis for basically for the who's who in the food business. And from there, I left. I worked with with a friend of mine, hedging currency, trading currency, and that just I got drawn back into agriculture from there. It just I started doing some project consulting on my own. Excuse me. If there is a Competition Bureau issue with grain handling and transportation, I was involved in it, either working on behalf of the Competition Bureau or the parties involved. The most recent one, I guess, was P&H bought Louis Dreyfus, so I was involved in that for P&H and Louis Dreyfus. So I do that kind of work. A project I recently finished. It was interesting. If you remember, I'll take a couple minutes on this one. It's kind of interesting. Back in 2013-14, if you remember, the crop was huge, much bigger than certainly the railroads thought, and they didn't have the equipment to move it. And although they were moving record amounts of grain, it was, remember, there's grain had been sold and had not been moved for weeks and weeks. And at the time, Louis Dreyfus had a contract with CN on some new associated with some new elevators they had built, and the contract stated that basically CN had to give Louis Dreyfus up to 104 cars per week at these locations before cars were allocated. Like, they're basically guaranteed cars. And in this particular year, they went weeks without getting cars at these sites, and it hit the news. And Dreyfus took them to the CTA, the Canadian Transportation Agency. CN lost at every turn. They appealed. Anyway, I got pulled in when basically CN had no more recourse, and it was a matter of what are the damages. So Louis Dreyfus hired me to calculate how much money they lost. And that was back in that happened in 13-14. I was hired, I guess, 5 years ago to do the calculation, and I was just a witness at a federal court hearing in December. That's how long these things take. So that's the kind of stuff I like to do, because I've been involved in the grain handling business and grain trading business. That's kind of where I like to go in terms of projects. I just worked with a farmer. I shouldn't name names. He was suing a grain company for losses due to a rogue buyer. I can go into more detail, but I get called into that kind of stuff. I guess because of my background in trading and in grain handling. So now what I do is I've started a few years ago. I started a hedge program. I recognize that grain traders look at markets a lot different than farmers, and there's the way the grain trader, grain handler makes money is different. And I thought, farmers should know how these guys look at the markets. They don't care if canola is $8 a bushel or $28 a bushel. They really don't care, because what they're working for is in the basis and in spreads. And that's where their margins are. And so actually they I think most would say they prefer higher prices because they know that farmers are getting higher prices. And I remember working at Cargill that we used to say we like dealing with people who are making good money. So so there's that. So I started this program, excuse me, about 10 years ago. I call it advanced grain pricing, where farmers sign up for the program, sign up a certain tonnage, and we actually hedge for them. It's not advisory. We don't say, hey, it's time to hedge, and I think you should do this. We just do it for them. We're given the authority to do it. It's a managed futures account. And we do that. We hedge a little bit at a time. We move the hedges, roll the hedges forward in a carry to earn the carry. And then we advise on the best timing on basis. We don't get involved in the cash trade at all, other than saying, okay, now's the time to lock in the basis. For instance, this year, I've been telling, so far this year, I have said, don't sell a pound. the basis, so that it will improve. I'm also kind of bullish on flat price, but my main focus is on basis and spreads. There have been years where our net return on this was higher than any street price all year. It's a matter of basically separating your basis decision and your futures decision. So we do that, and for the people involved in that program, I would also do market analysis, and I was putting out a weekly newsletter. And I found that by the time I'm writing, it's too late. It's not news anymore. So I wanted to find a different way to toss the newspaper, so to speak. So I started an app, an on-farm, online farm community where anybody can sign up for it. And what I do is when I see something worth writing about, I write it and post it immediately. And so the guys that I've been dealing with for a while, they really like it. Rather than waiting for a week and reading something that's not even news anymore, they see it in real time, and it's a better workflow for me. I just wrote something yesterday, had an idea about some thoughts on the Trump tariffs. Took a couple hours, wrote it, done. So that's what I'm doing, and what I want to do with this this app or community, I call it the trading floor. What I want it to be is I want to grow it to the point where I'm getting information from the farmers that are participating as well. And the information I'm looking for is cash prices that you're seeing in terms of premiums being paid, that kind of thing, because we're not getting good cash price information out of farmers. Out of grain companies. They're just not, the bids that you see online or whatever I call them stink bids. We know that they're buying at prices higher than that. I think this is actually something that's happened in the last 10, 15 years, the way they're buying. Excuse me. So what I'd like to do is build the community up to the point where we share cash price information that you're seeing, not necessarily prices that you're selling, although that would be great too, but what you're seeing, so we can then put it together, package it, and report back, so we have a better idea of what the cash prices are. The other thing I want is I want to know where people have their targets set. Target price contracts are huge now. The grain companies love them. They absolutely love them. And I know that farmers, the ones I talk to, the guys that love them. I don't like them at all. And there's a number of reasons we can talk about it. But if you have a target contract with, say, Viterra for 300 tons, that's all you know. But let's say it's at $14.50 a bushel on canola. You know that target's there. Well, Viterra knows that they've got 150,000 tons of that. So they've got a good look at what the fabric of the market. They know where there's a lot of selling. You don't, and I think that creates an unlevel playing field. So what I'd like to do is build up this community so then we get a better idea of where the targets are and where the substantial ones are, and then also share that. So we've got as good an idea as the grain companies. For instance, I've seen it happen time and time again. We get a good rally going, and in futures, and the basis will start to fade. It'll start to pull back, and we'll see it on canola. And I've been asked, well, why is that? And you take a look at it. Well, we're getting close to a round number in cash prices. It might be $8 on wheat, or $9 on wheat, or $15 on canola. All of a sudden, the basis is starting to get really bad. And that's because they know that if their bids, their lousy street price bids, actually trigger or hit target levels, they buy it. That's part of the contract, that if their price hits that target, they own it. Well, they'll want to do that only if they can widen the basis. And so you'll see that often, where the futures rally and the basis goes the other way. And I think that's a sign of this kind of marketing. I just don't think it's healthy. It takes volume out of the futures, and it creates an unlevel playing field. So that's what that. Sorry, Dean. I probably went longer than you thought, but I get rambling on this thing. That's my main thrust right now, is to work with farmers, providing good information about markets, and hopefully build it up to the point where where it's reciprocal.
Thanks for this. Well, it's a very good overarching thing, and the basis of why I wanted you to come on here, because it ain't rocket science. You go and you take your fixed and variable costs, you times in your average yield and your average selling price today. A lot of the numbers, they ain't black on the first iteration of doing stuff, unless you get creative, unless you mess with your rotations. You got to keep in mind your herbicide plan, all this other stuff, right? So what that means is there's maybe an opportunity for folks that have yet to just understand or take the time to look at growing the crop right. And for step one, grow the crop right, and then marketing the physical, or else taking a position on futures and then deciding when to sell it. That's another step. And then moving the physical and all the rest of it. So this may be more than a one single step process this year in terms of just selling the stuff and you move on with life. And my intent, and it's not unlike, I sent a text out to some guys. There's a new price discovery tool that's just being launched called Clear Cost Ag, John, and it's for the fertilizer, for the bulk conventional fertilizer, and for the diesel fuel. Most guys, if you want to, you got your local market and all that stuff, and you do all the blending for you and hold your hand and all that stuff, and that's your gig. That's totally cool. But there's other guys, they're pretty sophisticated, and they need 46, and they need phos, and they need X, 100,000 liters of diesel, or whatever the hell the number is, and all the rest of it. And instead of them having to go through the stress or go through the time of a lot of different things, it's kind of designated as a hub where you can go. Now, what I like about what you're doing is you have a farmer focus on your approach. I've talked to grain merchants and stuff with some of the majors, and like 75% of their wheat they buy on GPOs, on grain pricing orders, and then they have a term you utilize. They utilize a stink bid to buy up the rest of it, or the free stuff, or some guys need cash, and so they make their extra margin on the quote free stuff. But it is not at all a price discovery tool in terms of what's really cooking in the marketplace. The real price is what the bid is plus X, because they got a unit train to hammer through and all the rest of it. And my intent is to put in front of my people an inverted approach where they are empowered as best they can with the proper intelligence and understanding or access to it to make those calls, and in a methodical way, a non-emotional way. They all know when they need the cash flow and stuff. But a little brief backcast for you and me, John. Like, I started with Cargill in '87, and then you and me got to know each other when you were running Sparks Canada,
right,
and stuff. So we've got a bit of a history. We've happened to. I've got a tremendous amount of respect, regardless of how you feel about me, about all of the things you've done, and you've always had, in my mind, the proper lens to look at stuff with. So that's really what I wanted to convey to people, is provide this forum, one, for you to talk about what you're doing and stuff. And at the end of it, I'm going to send it out to you guys. If you want to get in on it, fine. And if you don't, I don't care. It's up to them and stuff. But really having unbiased market understanding as to who's doing what and why, it really is helpful to set it apart. You're not just getting it from your local person in an elevator. Like, this is well beyond what they understand or know and have access to. So that would be my spin on that. So what I'll do, John, is if anybody has any questions about this, I know it's a bigger group and stuff, so you can hit me back after. I'm more than happy to facilitate you connecting with John on that. And that, if you got questions now, we can talk about it too. What I will start with, then I'll just stop for a sec. Anybody got any questions about anything so far? Cool. So what I'm going to do now, John, is in terms of your bead on things, we've had the tariff discussion. There's some angst. There's been some Bill 45Z relating to ethanol production. Canola was kicked out of the metrics for utilizing it for turn it into jet fuel for whatever the reason and stuff. So what is the overall feel of the market for canola? We'll start with canola today in terms of stocks use, in terms of how's the trade feeling about stuff, and what's the market appetite looking forward to for the rest of the year? You indicated you really hadn't sold a hell of a lot of canola with your people yet, and that's a pretty broad brush. I'm just giving you let's talk. What are you thinking with that?
Yeah, sounds like a return to our conversation yesterday. It's interesting how markets react. Well, first on the tariffs, nobody likes them. And if not to be political, but I don't know if Trump is, as a friend of mine says, being dumb like a fox, or he's just dumb. Yeah, and again, this friend of mine said, "Oh, these tariffs." He's not. He's just using that as a weapon, as a cudgel. He'll never actually execute on it. The problem with that is the threat of it is you have to take it as if it's real, and so it has thrown a wet blanket on the economy. And I won't just say markets, but the economy. And I'm not an economist, nor do I pretend to be one. But even if he doesn't pull the trigger on the the complete tariffs on everything from Canada, it's created a market of an instability in the market, which is not good. We've got more volatility in the market just on a day-to-day basis. He's got a press conference apparently later this morning to talk about, I think, about tariffs. So be interesting to see what he's going to say there. In terms of canola, what I noticed when he first announced back in November, and some of you may remember this, he first announced that he's going to do it. It was after the election, and he said, yeah, he's going to, on Inauguration Day, that was it. First thing he's going to do, 25% tariffs on everything. Canola got hit hard, really hard that day. Excuse me. And well, that makes sense. And then I looked though at soybean oil and meal. They were up quite strong. Oil in particular was up 130 points or something. And I thought, well, why would oil be higher? And then it dawned on me that, well, if we're not shipping canola oil, and by the way, we don't ship much canola seed down to the States, about 200,000 tons a year, if that, and down to Velva, ADM and Velva, that kind of thing. But we ship about 2 million tons of oil. Mainly for biofuels, and so the credit thing certainly had an impact on that. But so oil was up because, well, if we're not shipping canola oil down to the States, they're going to have to use other oils, including soybean oil. So that's kind of bullish for American prices. So then I thought, well, I should look at the board crush margin, and that's where you take the futures, canola futures, and bean oil, bean meal futures, do the math, and you can calculate what we call a board margin for crushing it. Well, that day, that board crush margin improved by 27%. It was a huge jump. And I put up charts on it on the trading floor. And so there you have somebody saying, I'm going to inject 25% additional cost into your business. And the market reacted like that and said, okay, well, this is how it's going to lay out. Higher prices for oil in the States, lower prices of canola back home, and there's your, now your margin is intact. It's a way of the market saying, here's your margin. Added cost. Okay, so this is how it reacts. It didn't stay there, but I thought it was quite a fascinating look at how markets react to this. We've settled out since then, and of course, he delayed it. It's still hanging over there, so we don't know. But what I noticed is that we've done nothing with canola. We've done nothing but go up since on futures. And so I thought, well, we've got a pretty robust market here if it can withstand that. The crush margins did go through the roof. They've come off since. but they're still quite good. As one crusher told me when we talked about the whole thing about the Trump tariffs, he said, well, we've got the cheapest oil in the world and there's still good margins. We'll just sell it somewhere else. So that confirmed that, yeah, well, the market is pretty robust. And if you go to the balance sheet for canola, we can't export a lot, and we've already exported quite a bit. I don't know how many, look closely at this stuff, but China was taking a lot of canola seed early in the year. And there's a number of reasons for that. It has since tapered off, which is what I expected anyway. So we've exported about 5 million tons already. And in my balance sheet, my S&D, I've got exports plugged in at 7. So last half of the year, we're only going to export 2 million. I find it hard to believe that that 7 million ton number that I've got plugged in, which I think is close to what StatsCan has as well, all right, Canada. I don't know if we can hold back, put it that way, especially if we have to find other markets, because we will. So I think that what that's telling me is, and by the way, at 7 million tons of exports, 11.7 million for crush, that gives us 1.3 million carryout, which to me has been bottom. Because if you remember, July 31st carryout, whatever you have left on farm in the system has to last until, call it early September, mid-September.
Mm-hmm.
So that's like 1.3 million for that's been bottom. And so I'm thinking that it could be even tighter than that. So am I bullish? Yeah, a little bit. I'm quite bullish on basis and spreads, though, because as I said before, that's kind of my wheelhouse. So so I think basis is going to improve quite a bit. The other thing, since you got me rambling here, I might as well talk about it. The other thing that I don't know how widespread it is. I've been told by some people that, well, I wish people would talk about this more. So I try to. The railroads used to just set a price, a rate, the freight rate for the year. They now do it monthly, and the highest freight rates are in the fall into January, February, and then for the last half of the year, they scale their freight rates back because they can't go over the revenue cap, and so they what's interesting is they were as high as from where you are, Dean. We talked about this yesterday, about $80 a ton. Mm-hmm. Well, later in the year, they'll be more like $40 a ton. And what that does is have a significant impact on basis, because that freight rate has to work into the basis somehow. So I just want to throw that in. That's also another reason why you should avoid basis early in the year if you can, because you're avoiding those freight rates. But yeah, basis will improve. Anyway, I'm way off topic. Yeah, Trump tariffs, hate them. We'll live. That's the summary.
Yeah, relating to the canola, just so you know, just some real quick math based on the farms of influence we've got on the call, and then I've got a few folks that work with other farmers in here. People are coming and going, but there's about 1 million tons worth of canola influenced on this call, or access, whether it's one guy dealing with 10 guys or their own farm and all the rest of it. So it's not a bad, I wouldn't say sampling, because we're not going to pick on anybody, but the point being is that the interest is really quite prevalent on maybe some clarity on where this is going to go. Like, now, relating to your specific customers right now, what % of their 2024 crop is sold, and what, if anything, have you done on the 25 crop? And at what futures level do you have interest relating to both of those scenarios?
What's the last part of the question? What future
level do you have interest? Do you have a magic futures number you're looking at to execute on something?
Okay, remind me of that. This crop here, okay, the guys that are in my program, typically what they'll do is allocate maybe a third. Some guys go up to as high as a half of their production in my program. When I first launched it, I called it it's a storage play. So in other words, I'll show you how, or we will earn the carry, get paid to store, and so when the first couple of years I did it, we did nothing until we had hedged nothing until into August, September. So we didn't do any forward pricing. And the reason for that was, I didn't want to be the guy to say, sell canola at $13 and then watch it go to 18. I just didn't think that was my role, because now you're talking about the actual net price. You got to look at cost of production, which that's your wheelhouse, not mine. And there's debt levels and all kinds of stuff. So I don't like getting involved in saying, yeah, you should sell it here. What I do is say, okay, I can build you a price where that will, and I don't have a magic number, but I can build you a price that will get you in the top tier of the price range that you'll see all year. And in fact, I may have said it already, in fact, there are some years where our net price was higher than any street price. And so I don't have a magic number saying, oh yeah, well, we're shooting for $700. What I'm doing is I'm shooting to pick up an extra $1 a bushel or more in carrying charges, and maybe that much again or more in basis appreciation, and knowing when, understanding basis. I find it interesting. A lot of advisors that I've talked to, anyway, they focus on flat price, and basis. I remember years ago when I was on my own doing this. I was at a meeting, and some guy with Cargill was talking, and he was saying, don't worry about basis. Nothing you can do about it, and it doesn't change much anyway. And I just about spit my coffee out because that's where they make their money. And so so I just focus on more on basis than that. So this year, you're talking about this year, the stuff that I've got in the program, which is not, people.
I get it.
Percent. We're about 30% done in the program. Zero basis. We haven't done a thing on cash price. So what we did, we sold November futures. We rolled that to the Jan, and if I lose anybody on this stuff, because I tend to do, call me or Dean, we can talk about it one-on-one. But we sold Bob futures. We rolled that to the Jan at 13 under. So what that does, that improves our hedge by $13. Simply because you're buying it one back and selling the next one 13 higher. Well, I can show you the math. It just improves your hedge by 13. Jan March, I have an issue with how Jan closed, but we got Jan March down at 13. So there's $26. We just improved our hedge. We did March, May already at about 7. And so there's 13, there's 26. And so we're over $30 a ton improvement to our original hedge. And we're going to do May, July. I've got orders in at 5 under. Might be hard because May, July will tighten up. So if we get another $5 there, we're threatening $1 a bushel pretty closely just on that. Our average hedges are around 6. I think with all that included is around 670 right now. And that's that's on a third of the crop. Basically, well, no, a third of what is in my program. So they're about 30% done. So at basis, like I said, I'm not touching it, not until I see something improve. Now you might say, well, hang on a second, I got to sell, for cash flow or whatever. Yeah, do what you need to do. I don't tell people that they can't sell. They need to sell. Okay, well then, this is what we'll do. We'll react to that, in the program on an individual basis. So, 2025, you asked about that. We haven't done a thing yet. Like I said, I tend not to do forward pricing. What I have done is if a guy says, look, I'd really like to start hedging at, let's look at the numbers here, 675. I'd like to, if we can get up to, or I guess not 650. If I can get, say 675, I'll sell some there. Okay, now I know what he wants to do in terms of a flat price, and we've done that successfully. So that's where we'll start, because he'll, with direction from the client. I won't just start doing it, but as long as I know they're on side with starting it that way, that's fine. And then we just, when the spreads widen out, and as they do, we roll forward and improve on that hedge. So we haven't done anything on 2025. And your third part of the question was, is there magic numbers? No, there's no magic numbers. We just build the price.
Mm-hmm. All right. So on that, real quick, a lot of the discussions we have is the fundamentals versus, I think, versus the charts. Do you factor that into your ciphering on stuff at all, or what?
Yeah, I do both. To me, the fundamentals is a kind of long term, and technicals more of a short term thing. So if obviously in the program, we're a hedger. We're always looking for a place to sell it. So if the market is trending higher, and showing you've got good underlying support, you're above the moving averages or whatever, why would I sell it? And that's why we haven't sold much, is because we've been checking along, and so if the market, we look for market signals that the market is turning, and so if I see this thing turning like it's going to go crashing down, that's when I sell it, and I try to get ahead of it a little bit, but so I use technical signals as a point of entry, but my fundamental view drives what I want to do on spreads and that kind of thing.
Yeah, thanks for explaining that. A couple things that come to mind. Can you, for those of us that maybe aren't quite as comfortable as the terminology, but what would be a reasonable number for, we'll call it full cost of carry on a month-to-month flip? You indicated you're at 13, and then there's another month you have to take 7. There's that March, May, you're looking at 5. Like what would be the optimum flip on to capture that?
Well, there is a thing we call full carry, which is the full cost of carrying futures deliverable paper from one month to another. So if you take delivery of March and hold it and deliver it, re-deliver it against futures in May, which you can do, what would that cost you? So it's interest and storage. Well, I call it storage. The exchange calls it something else, but so it's an easy calculation to figure out what the full cost of carry is. If we have a year where there's ample supplies around and it's going to be like a burdensome carryout, we know spreads will widen. And what I will look to do is roll hedges at about 80% of what I calculate full carry to be. Will it go up to full carry? Yeah, but you get out to, we did 13. I think when we did 1300 Jan, I think full carry was maybe 15 to 16, and it depends on who you're talking to. Everybody's got a different effective interest rate. When I was at Cargill, full carry to us was less than others because we could borrow money so cheap. So that really factored in how we approached it. So can it go to full carry? Yeah, of course it can. But why would I wait? If I've got $13, if I'm looking at $13 spread, why would I wait for 14.5 for a buck and a half? It could go the other way. So something could happen, which is what happened actually in the Jan March. We were short NAV, and in December, Jan March we were short Jan at that point. Mid December, Jan March was 1300, that kind of number. I thought, well, why would I wait till the end of December? Actually, it was beginning of December. I might as well do it now, and so I did. And I just got lucky in a way, because toward the end of December, the spread started tightening up, and it actually inverted. Jan March inverted, and I've already written a letter to the exchange, because the best bid that I saw, that from the exchange, they publish what they see as the best bid. was 36 under January futures on December 31st. And somebody took delivery, stood there and said, I'm taking delivery of futures at futures price. So they could buy cash at $36 less, but they said, no, I'm going to take delivery. And there's reasons why you might take delivery to redeliver. There's reasons why you might do that. But then immediately, once they got that delivery paper, they asked to ship it. They called for shipment, we called it. So that was really strange. So they're taking delivery of futures and shipping it against a sale at futures price when they could have bought it at 3,600, or maybe better than 3,600, but better, certainly better than the futures price. So I started asking questions, because that to me is classic squeeze. And it was Viterra that took delivery, and they shipped it, and nobody could give me a good answer as to why they would do that. In fact, one guy, I shouldn't name names, but one guy who actually delivered it to them, he said that was the best sale he's made in a long time, selling grain at futures price and moving. We could not figure out, why Viterra did that. And it comes back to, and my theory is, it comes back down to manipulating, and I'll use that word, manipulating their cash bids. So let's say they're the ones that were 3,600. They're doing hitting the grain pricing orders, as you call them, or target prices above that, but maybe they've cleaned out everything that they that they had. I don't know. Why would they actually take grain at futures price when they could buy it a lot cheaper? And it just didn't make any sense. Then it dawned on me that December 31st is their year end. This gets a little complicated, but this is the way my mind works. Their year end is December 31st. And I also heard that the grain market, grain trade in general, was short cash. They sold a lot more cash, and they tend to be short, but they're really major shorts. And that's another reason why they'll keep their price down and just buy up, cherry pick as they need it. So December 31st, it's their year end. If they were to raise their bid, which they should do before they stand for delivery of futures, if they were to raise their bid to 2,500, 2,000, whatever, at year end, they would have to value everything, including their shorts, at those higher prices. And therefore, they would show a huge paper loss. And it's my opinion, that's all it is, because I'm in a dark room with a candle. I don't see the whole thing. I think they used the futures to satisfy a sale without raising their price to farmers, because that would show a big loss. And that's an improper use of futures. And so what happened was, the cash basis was giving us the signal that there's a lot of canola around a comfortable whatever, and the calendar spreads inverted, which tells us the exact opposite. And I've got a few others, a couple of friends of mine who are traders, and we're worried that the exchange isn't paying attention. But that's the kind of thing I look at, and so when I talked to the exchange, they said, well, it only affects those people that are in the delivery market, those taking and making delivery. I said, no, it doesn't, because it affects spreads. I trade spreads. The March, May, I did that at, what did I say? It was 7 under or something. I could probably, I did it because I got out of the March because I was worried that this was going to happen again. So it affected my behavior, my trading behavior. So anyway, I'm not sure why I'm talking about this, but you got me talking about it.
Well, it's good. It's very interesting because there's a lot of things that you don't see on the board occur, and if on that physical side, like you said, the numbers I've heard is it's like 50, 60,000 tons that they needed to make a play on. So a couple mil plus bushels, right? Like that's, and if they were going to do that in we'll call it the traditional marketplace, it would upset their interests with what they want to show the marketplace. So totally I get it.
I think what it shows is I'll use the word a cavalier approach to public cash price information. And I think I don't know when it happened where they started buying above. They have this this street price mentality, stink bid I call it mentality, where they do both. They're buying above that, and it dawned on me that they make money on overages. So you sell 100 tons of grain to a company, and you end up shipping 105. That you got an overage of 5. Some will say, if you got another contract in place, we'll apply that 5 to the next contract. But others, you may not have another contract, and so that 5 tons is bought at their stink bid price, their street. It's not at contract price necessarily. Well, they can make a lot of money on that, just on the margins. It used to be the break of the beam, the old beam scales. There was dockage, and when I started in the business, we talked about dockage and tookage.
That's right.
And now it's like, I thought, well, they can't do that now. It's all digital, and so to me, this is a way of taking the break of the beam.
Yeah. I just had one. I'm getting some texts from folks, and you can just shoot me a text if you have questions you want me to ask or whatever. We're rolling along. But do you feel that a play like this would have had anything to do with the Bunge Viterra re-synergizing, and how like that play on canola, or would it have nothing to do with it?
Re-synergizing, explain that word.
Well, Bunge and Viterra doing their deal, right? Just got approved, and with them making the choice on the cash, just like you said, on this 50,000-60,000, is the rationale behind that as a reason?
Yeah, somebody else wondered about the same thing, that the deal had been approved, but you wonder when the actual closing date is. And of course, you don't want a huge paper loss on the date where this deal like that goes through, if you're a Viterra shareholder. So that's possible. And I don't know anything about, I did work for Bunge and Viterra on that deal a little bit. I'm not sure when the excuse me, the date of the deal goes, that it actually goes through is, but that could be a factor. It's like, it's you're painting a balance sheet basically. I get that. Yeah. But okay. That's interesting to talk about, but I have no evidence that even suggested anything like that. That's interesting.
Okay. No, thank you for that. Okay. On the canola side, anybody have any other questions before we pick on wheat? So if you think of anything, guys, just shoot me a note and I'll get it out there. So on the wheat front, what has been your strategy with the wheat? Does it a mirror of canola? Like, how are you playing the wheat market this year? Yeah. And what do you see things? Where do you see things at? Yeah.
It pretty well mirrors it. I don't have anyone in wheat this year. We've had a wheat book before. We'll certainly do it again. Canola really is my wheelhouse. I'll say that. From my days trading on the floor, helping design the contract, getting involved in the deliveries and everything. I don't have that same comfort level with Minneapolis wheat, and most spring wheat is hedged in Minneapolis wheat, if it's hedged at all. So I look at basis quite a bit on wheat, and of course basis on wheat is different because it's you have the currency embedded in the basis for most of it. I think Patterson and G3, correct me if I'm wrong, I think they convert futures to Canadian and then show a true Canadian dollar basis. So they'd be more like 25, 30 under right now. Everybody else would be 65 over, because you've got the currency in there. So we talk about currency a little more with when we analyze wheat basis. I had a conversation with a friend, a client, whatever. He was looking at blocking in wheat basis when it was around 70 over. And the first thing I asked him, I said, well, what's your opinion on the dollar? And we both agreed that we were both bearish on the dollar. It hasn't really done much lately, but I said, these are 70 overs is historically a very good basis on wheat. And so I think he pulled the trigger and just locked in the basis. And now we're about 65 over. I think our basis has taken a hit because of the tariffs. And what's interesting is since all the noise about the tariffs, spring wheat futures have moved up. And again, I think it could be because they anticipate less wheat coming in from Canada. So their balance sheet is skewed a little bit more. They need higher prices. But our price hasn't changed, really.
Mm-hmm.
I was meant to send you a chart and I didn't. I'm sorry.
No, that's all right.
Yeah, but our and I'm talking about their posted price. So who knows what they're actually paying? But the posted prices really haven't changed much, and the difference is in the basis. And so just back to Trump tariffs, that clearly shows that the consumer down there is going to pay. They're paying more for wheat now. And eventually they'll have to pay the tariff. The wheat buyers down there said we're not paying the tariff, and so that will cut off any future sales into the U.S. until they decide they will pay the tariff, if the tariff even lands. But anyway, so yeah, we look at basis a little differently because of the currency. In terms of the carry in the market, I have less of a view on the delivery mechanisms and the cash to futures on Minneapolis. I've tried to find somebody that'll talk to me about it, but so it makes it a little more difficult. But if you just go back to your fundamentals, you can make sense out of it. And wheat does show good carry. When there is a carry in the market, they'll show a good carry, and so we can earn that. And so is it a mirror to canola? Yeah, it's pretty close. It's pretty close.
Mm-hmm. Yeah, and again, the reason I'm bringing this up, but this again may be another year. Like lots of times when things get like, we had one of our shares earlier on say, we're still waiting for maybe some crop insurance numbers to help to determine some tweaking of acres. We have folks that have unfortunately been in a catchment zone where it don't matter what you grow if you don't get above, or if you're consistently below 2 or 3 inches of rain, it don't mean a goddamn thing, right? So we've got some people that are going to have to function in that sphere. So it's almost a different conversation with those guys or those enterprises versus those that are okay, step one, I got to grow the crop. Step two, maybe this might be a year where utilization of futures functionality, be cognizant of what the currency is going to be doing, and all that is going to be a part of it. We've got some people on the call. They've got some really good relationships with some millers, so they do a mill direct thing. So that don't really, you don't really see a lot of that stuff on the board and whatnot. But there's a lot of angst and a lot of. So I've been spending some time talking to banks. And BNS and RBC both within the last 10 days, and they are resolved to the fact that we've got the variable costs can probably be covered reasonably, but the fixed are where the things might need to get punted down the road a little bit, depending on what a guy's cash position is and all this other stuff, right? So they are currently quite interested in those plans like this where you can leverage additional revenue that's going to help cover their ass, right? Always, but also their customers. And then just so that people can bloody breathe in and out normal and stuff. And so having an intelligent approach to the right marketing is going to be useful.
Mhm.
You know, my gig is on the cost mitigation, crop optimization, grow the crop right, and all that stuff, and keep the, you know, protect the crop with, you got the rain and the diseases are there and all that other stuff. But on the other side, I think both are going to be quite scrutinized this year. Getting back to my weak comment, or what they're going to grow. Lots of times when things are really tight, guys go back to what's simple. I'm not going to get cute and fancy with a bunch of stuff. I'm just going to stick to my knitting and you know, grow it well, but maybe keep a head up on stuff like you got, to just see if there's a logical fit on a portion of the crop, just to kind of get comfort with how the system works, and then determine, you know, how big does that get.
Yeah. Yeah, you know, I'd just like to say, you know, what I've developed with the hedging program isn't a silver bullet. It, you know,
Sure.
but what it does is, yeah, I always say that hope is not a marketing plan, and the market is never ever telling you to wait. It's telling you what to do, either sell for delivery now or sell for delivery later. But it's never saying, oh, wait. You know, if you see a carrying charge in the market, it does mean that, oh, it's predicting higher prices. The markets don't earn their carry. You know, it'll disappear over time. So, you know, what I do is I say, okay, I don't think that just waiting is a good strategy. So if you do want to delay some shipment till later in the year, or you think you can afford to do that, you might as well get paid to store it. You might as well have an approach to maximize your opportunity in terms of, you know, not locking in a basis. I really don't like basis contracts, you know, to be priced later. I think it's better to do the futures first, and not a futures first contract, but do, you know, do a futures position before you do basis. But yeah, I just think that for a portion of the crop that you know that you're going to sell in the last, you know, after seeding, or, you know, whatever, even just before seeding, it makes sense not to just wait. That's my point. You might as well earn the carry as opposed to watch it disappear.
Yeah, well, waiting is a marketing decision as well, whether a person wants to call it that or not. There's a buddy of mine years ago, he told me, there's those that make things happen, those that watch things happen, those that wonder what happened, right?
Yeah.
So and you know, your take maybe can provide a bit of clarity, which is always useful, and it may not be all the be all end all, but it's definitely a position to listen to, right?
Yeah. Sorry, I was trying to interrupt. I shouldn't have.
No, go ahead.
No, it's okay. I can't remember what I was going to say.
Yeah, isn't that? Hey, dude, when I'm touching 60, so that's what happens. You know, you and me are about a decade apart, so you're doing good. Another question I just had come in was relating to with situations that are the way they are, what percentage of the market is being controlled by just the funds, just the managed money? Are they, how big of an influence are they going to be on the market in your mind? Are they today, with the funds being in place? You know, are they moving from the grains and oil seeds to other stuff? Or what percent of the market are they representing today, even?
I'm glad you asked that. I was just updating my charts or my data on that. Okay. They I'm going to be writing about it on the trading floor. They today, I think, the funds in canola have gone from back in September, they were over half the open interest in futures. 52% of the open interest was managed money. That's huge. That's huge.
Wow.
And that's when they were a huge short position. And they have that was I'm just looking at the net position was 138,000 short, 138,000 contracts. They're now short 6,000 as of a week ago. They're about 35%. 30-35% of the open interest right now. That's both. That's everything. Some of them are long, some are short. My view is that when we get the next week's data, commitment of traders comes out every week. I think they're going to be long. I think they're supporting this market right now, and once they're long, two things happen. They like to add to it, which is supportive to the market. But also, if they decide that they're wrong and they want to get out, it can demolish the market pretty quick. I don't see that happening. I shouldn't throw that out, but they so they are a significant factor, which I think last summer, fall, the drop in the prices came on a lot because of funds were selling and selling and selling and selling. And that's going to weigh the market. So I think they're short answer, they're a big factor, and they still are. They're not getting out of eggs.
Well, you're 100%. I'm aligned with you, absolutely saying it, because we all know that we're one tweet or one X away from a lot of things going sideways, and it has nothing to do with anything other than some political thing.
Yeah.
And then therefore they exit and go into safer things, right? But at this time, being that they're in that half-ish range, and it sounds like they're on the bullish side of the ledger for now, that's what's on the table or whatever, right? So there you go. Yeah, cool. Okay, it's an open floor now, guys. Thanks for all your patience and your indulgence as me and John have visited. Thanks for those that have been shooting me some texts on some questions. Open floor. Anybody got anything there that's in their mind while we got John on the call? Hey, Greg.
Yeah, so I don't know where this all fits in, but I just wondering, John, our last couple of years, our best time to sell cash-wise ended up being in the fall. How's that work when you're doing your strategies?
So best time on a flat price basis or
our best cash price was basically in the fall, unless you held really long into the spring or whatever.
Yeah, we went through a couple of interesting years, didn't we? It started in 21 when the market shot up. When we shot up to what, $1,100 on nearby futures. We were running our program. We were hedged a little bit because we're never hedged a lot. We hedged a little bit, and the market started moving, but also the spreads inverted. The spreads were tightening up, and I can't remember exactly what year it was, but so I thought something's going on. I can't remember what the news was coming in. It looked like things were going to be tighter than we all thought, and so what I did is I rolled our hedges from November to July, and almost right out, and not up to Jan to March, May, all the way up to July, and picked up $2 of carry. So but I just wanted to avoid, get out of the way basically, and so now we're long cash, which is always to me nearby. Short minor as it was in the July. Excuse me. And then the market's inverted. And so when a market inverts, it's telling you sell your cash for delivery now. And so I was telling guys that I remember the March cash was like 40 over the March of this time. And I said, just sell it. Sell your cash because 40 over, that's great. And we started changing the view. Rather than if they sold the cash ahead of time, what I would do is buy futures. And so I bought March futures, and so then I maintained being long the spread. So not to get too technical, ordinarily we'd be short spreads rolling forward. That time we quickly adjusted, and instead of earning the carry, we exploited the inverse. And we just worked our way out of it that way. Still made decent money. The next year, the market was still very strong and markets were inverted. And I just told guys, the program, the hedge program that I had built won't work when the market's inverted like that. So I said, basically, all I'm going to do is tell you when to sell. So I stayed in touch with some guys. We worked out some strategies. I didn't really promote the program because it was basically, what price do you want? Sell it. And that reminds me of a guy I was working with. He called me up and he said he's got 2,000 tons of canola left, and he's being offered $25 a bushel for it. So what do you think I should do? I said, you're kidding, right? He said, what are you waiting for? 27? Good thing you didn't call me when it was 20, because I would have said sell it at 20. But you see prices like that, and it just you just take advantage of it. But then, to your point, the market started to slide, and basically came back to reality after, I think it was maybe 2.5 years of these uber high prices. And so I think that's what happened. I'm just going by memory, but I think that's what happened. Because the market was sliding, the earlier you could sell it, the better. So I think that was a hangover from those days. So the first time we were caught short, and I think the second year, isn't that the year when was it 22 or 23 when we didn't grow enough to satisfy the forward sales? Not mistaken, and that might have factored into it. What happened was prices were so good, $800, $900 a ton. Guys forward sold more than, and I'm probably preaching to the choir here, sold more than they ordinarily would, and then had we'll call it a reduced crop. So I read some stat that 70% of farmers in Saskatchewan sold more on a forward basis than they actually produced. And so they're short. And so they've got to cover. What that did, though, was made the grain companies short, because they're not just buying grain from you and waiting to sell it. They've sold it too. So you sell it to them on a forward basis, they go and sell it to China or whoever. So they're short. You guys come up short, they're coming up short. So the bids just skyrocketed. And that would have been in the fall. And because that's when they needed it. That's when the sales were. And I'd have to look at a chart, but it would have tapered off. So
yeah, Brett just kicked in 2021 was what he figured. And I think that seems correct to me in my little brain.
So we didn't going into that event, that 2 or 3 year event, we had a program, but we didn't run a program for the rest of it. We wanted to wait until the market settled down. There's better ways to market in that kind of environment than what I'm just saying. Okay, if you've got something to store and you want to build a price, we can do that. And so it's like one component of a marketing plan. That's all. I'm not trying to say it's to be all and end all. So, Greg, to your question, yeah, I think I've explained what happened there in my mind anyway. And so what happened was the market was drifting lower and lower, and the faster you could sell it, the better. So in those years, that year in particular, we could see what was happening. But this year we've got good carry. I think we'll have depends on the crop next year. I'm not going to say we're going to have good carries next year. This program may not work next year. But I think right now the way the market is sitting, we're back to what I would call normal carry type markets, and so it's going to have value. But I don't know if that answered your question, but in a situation like that. Nobody can predict the future, but it made sense to sell, but early because what we were coming out of.
Nope, thanks. That answered it.
Yeah, okay.
I'll make the same statement in a just to cover it in a different way as well. Getting back to my comment on the banks and the cash flow, guys running their crop forecasting and revenue, there's likely to be a higher level of cash needs come fall time to both catch up from this past year a little bit, but also for deal with pre end of 2025 needs for cash. So therefore there will be appetite for, if it makes sense, for ancillary things beyond just selling the cash whether it is the best price or not, right? There's going to be a third of that canola is just going to come just because guys need to bank. They need bank, man, right? And stuff. And so that's another factor in the mix on that. Sorry, John, I cut you off. You're going to say something.
No, I'm good. I'm just stretching.
Anything else from you guys? Well, this is great. I want to thank each of you for taking the time. I know one of the most valuable things you guys have is your time, and I'm grateful for that. I'm thankful for you, John. John and I have talked a little bit about doing some collaboration with iFarm and the trading floor and what we can maybe do to help farmers. And so there'll be more to come on that as we get some things sorted. But with that, I want to just thank everybody. Well, hopefully you don't freeze anything important as the climate readjusts. So into next year, it's supposed to be a little bit more temperate. So that's cool. But if anything of this is of interest, if you didn't hear things right, if you have questions about it, hit me back. It's totally cool. You have my email. You've got my cell number for direct call or text. And I want to help if I can I'll just redirect you to John on stuff if you want to take it somewhere. So with that, thanks everybody. Appreciate everything. Right on.
Thanks for the invite.
Yeah, and go. It's kind of fun to watch Team Canada and the Four Nations hockey.